Let's jump right into this explainer. Today we're decoding the mechanics of double entry accounting. We're getting our insights directly from Sharon Ferris's super practical book, Nonprofit Bookkeeping and Accounting. So whether you're running a nonprofit or just, trying to wrap your head around your own financial records, mastering this system is basically your golden ticket to financial clarity.
So let's kick things off with a question. Why are accountants literally obsessed with balancing the books? I mean, why does every single penny have to be perfectly accounted for on both sides of a ledger? Well, setting up the foundation of accounting really requires us to understand that it's just a system of maintaining perfect equilibrium. It reflects reality. You can't just create value out of thin air. And on the flip side, value doesn't just vanish.
And this perfectly illustrates where that accountability actually starts. Look, before we even think about touching a computer or firing up a spreadsheet, we have to respect the manual foundation of bookkeeping. Tracking every single transaction requires a really reliable, immaculate paper trail. Every receipt, every invoice, every check you write, it all creates a path that explains when something happened, why it happened, and exactly how much money was involved. But to really get a grip on tracking all this, we've got to learn the core vocabulary first.
Section 1. The Basic Accounting Equation.
Okay, so the absolute golden rule of accounting is this. Assets equal liabilities plus equity. This equation right here is the beating heart of your financial statements. Honestly, no matter what happens in your organization or how many crazy transactions you make, this equation must absolutely always stay in balance. If the left side goes up, the right side's got to go up too, or, something else on the left side has to go down.
Let's break those terms down directly from our source material so we're all crystal clear. Assets are the tangible things that give your organization an economic benefit. Think the cash sitting in your bank, your office equipment, maybe property. Liabilities, on the other hand, are the obligations you owe. So your accounts payable, the utility bills, a mortgage. And finally, equity, which is often called net assets in the nonprofit world, is simply the difference between your assets and your liabilities. It's basically your net worth. But how on earth does this equation actually stay balanced out in the chaotic real world?
Section 2. The double entry system.
To keep that perfect balance, here is the absolute crucial point you need to remember. Every financial action requires an equal and opposite reaction. Whenever your organization makes a transaction, you have to record it in 2 or more accounts. You're never, ever just doing one thing in isolation.
Let's walk through a super simple, everyday example from the book. Let's say you go out and buy $100 worth of office supplies with cash. So what actually happens? Well, your assets, in the form of office supplies, go up by $100. Awesome. But at the exact same time, your assets in the form of cash go down by $100. See? 2 accounts are affected simultaneously, and boom, your overall accounting equation is still perfectly balanced. Now, to actually record this stuff, we really need to strip away the confusion around 2 of the most intimidating words in all of finance: debit and credit.
Section 3. Decoding debits and credits.
People hear these 2 words and honestly, they kind of panic. But let's redefine debits and credits purely as directions on a map, or even just the sides of a giant letter T. Actually, that's exactly why it's often called T accounting. Debit literally just means the left side of an account, and credit, it strictly means the right side of an account. That's it, left and right, nothing more. I absolutely love this quote from Sharon Ferris's book. She says, "Accounts are like coins in that they have 2 sides." It's such a brilliant way to illustrate that you really shouldn't attach any kind of moral value to these words. A debit isn't inherently bad and a credit isn't inherently good. They're literally just the left and right sides of your accounting coin. So let's look at the grammar rules of our accounting language to see how these sides actually change the totals in our accounts.
Section 4. Rules of normal balances.
Before we get into the rules themselves, we have to understand this term, normal balance. This rule simply tells us what action, meaning a debit or a credit, we have to take to make a specific account's number go up. If you know an account's normal balance, you instantly know how to increase it.
All right, this right here is your definitive rulebook. Notice that assets and expenses both have a normal balance of a debit. That means if you want to increase them, you write the number on the left. On the flip side, liabilities, equity, and revenue all have a normal balance of a credit. To increase those guys, you write the number on the right. And what if you want to decrease any of these accounts? Easy. You literally just do the exact opposite. So, now that we've got our vocabulary and our grammar down, let's actually put it into practice.
Section 5. Recording a journal entry.
To write an accounting sentence, we use the journal. It's known as the book of original entry.
Basically, it's the very first place a transaction is recorded, way before it ever hits your official ledger or your financial statements. Getting this step right is absolutely vital because it sets the stage for literally everything else.
The source text lays out this incredibly clear 4-step process for successfully recording a journal entry. So let's walk through these 4 steps one by one and see exactly how it's done.
Step 1 is the date. You write the year in small figures, then the month, and then the day. Now this might seem totally obvious, but remember that paper trail we talked about earlier? Keeping your books perfectly chronological is literally the only way to make sure your records can be tracked and audited easily down the line.
Step 2 is listing the account names, and there is a very specific formatting rule you got to follow here. The account you are debiting always goes first. Then, right underneath it, you write the account you're crediting. But, and this is key, you indent it about 1 inch. This visual formatting ensures that anyone reading the journal can instantly recognize the flow of money without even having to look at the numbers yet.
Step 3 is writing in the actual amounts. Your debit amount goes in the left column, directly across from the debit account name. Your credit amount goes in the right column. Oh, and here's a fun little pro tip from the book. Skip the dollar signs. Seriously, in the ledger, everybody already knows we're talking about money. Leaving them out just keeps the columns nice and clean.
And finally, step 4, a short explanation. You want to indent this about a ½ inch below your accounts. Jotting down the exact details, like who a donation was from and the specific check number, creates that ironclad paper trail we mentioned at the start. It completely removes the guesswork for whoever might look at this book months or even years from now.
I want to summarize our explainer today with this really empowering quote from the source. Accounting reflects what happens financially by increasing and decreasing accounts in the form of debits and credits. That is literally all it is. It's not magic, it's not some kind of impossible math. The double entry system is simply a logical, structured reflection of financial reality.
So we've broken down the equation, we've mastered left from right, and we've walked through the precise steps of a journal entry. Now that you know the mechanics, what financial story will your perfectly balanced books tell? Take these tools, apply them to your own records, and take absolute control of your organization's financial health. Thanks for hanging out with me for this explainer, and keep learning.